Good morning, I'm Andrew Topf with Investing News Network, and I'm here with Lawrence Roulston, who puts out the popular investor newsletter Resource Opportunities. Thanks for being here, Lawrence.
My pleasure, Andrew.
So Lawrence, at the end of 2012, you said many junior exploration companies are trading well above their values. 2 months into 2013, do you still feel that way?
Well, actually, my comment at the end of 2012 was that probably the majority of companies were still overvalued, but within that, there were a number of really high-quality companies that were grossly undervalued. And in that time, the whole market has continued downward. So some of those companies that I saw as overvalued are less overvalued, but the high-quality companies are now even more undervalued than they were at that time. I've never seen a time in this market when there's more importance on differentiating between the good quality companies and the less quality companies.
Okay. And on that vein, so you've said that investing in companies based on whether the metal they're exploring for will go up. In other words, ensuring that the price of metal goes up and making that as sort of an investment criteria. But you said it's better to look at companies that have actual metal in the ground. So do you have any tips for investors in terms of differentiating which company to invest in?
Well, yeah, I've always maintained that people should resist this temptation to jump on the flavor of the month or a commodity bandwagon. And we've seen it over and over with various fads that have passed through, the uranium boom and moly and rare earths, and of course gold being, kind of the perennial favorite. A lot of investors in the past have jumped onto a company because it has gold in its name, thinking it's going to give them exposure to the gold market. And that's not always the case. In fact, a lot of these companies that are hoping to make a gold discovery next month are not ever going to make a discovery, and you're not getting exposure to gold in the ground. If you want exposure to the commodities, you have to have a company that actually has some of the metal in the ground, and it has to be metal that will eventually get mined. And that's not the case with many or even most of these companies. So, but furthermore, when I invest in a company, it's not ever on the basis of expecting a higher metal price. I'm looking at any company that I look at. Does it make sense with a realistic expectation of a metal price or the current metal price? And if there is a rise in the metal price at some point in the future, I see that as a bonus. The company has to make sense on the merits of its projects in the context of the current metal prices.
Okay. One of the best strategies for investing in junior mining companies is trying to identify takeover targets. So last year was a slow year for M&A, and it was the slowest since 2008. Do you see any evidence for an increase in M&A this year for the junior sector?
Well, in spite of it being a slow year, and it was a slow year, there were quite a number of big takeovers. 3 or 4 of the companies that we follow in the newsletter were taken over in the course of the year. But what was really, really important, and a trend that I see getting more important, 2 of the companies that we follow in the newsletter were taken over near the end of last year. Total value of those was $600 million, both cash offers. One came from a private Brazilian company, and the other came from a Chinese company. Companies that most investors up here would never have heard of. Since then, I've really picked up on this trend. And another company that was taken over last year was a $500 million takeover by a private Egyptian company. So we've put together a list of several hundred companies that are active in the mining industry, that are currently producing and capable of writing checks for hundreds of millions of dollars. And I would guess that not a handful of those companies would be known to most of the analysts that follow the mining industry. These are companies mostly in the emerging markets. A lot of them are private companies. Some of them are owned by governments, but they're in the industry, they're looking for takeovers, and they're capable of writing checks for hundreds of millions. Now, in addition to that, there are hundreds of other entities that are coming into the resource industry that are not presently players. And the Egyptian deal I mentioned is one example. A construction company, a cement manufacturing company in Egypt that decided they wanted to get into resource, and they wrote a check for $500 million.
You've mentioned that those regions they place a greater value on our resources, resources that the North American companies are looking at.
Absolutely. In the West here, we whine and complain about the slow growth in the American economy and the recession in Europe. And we tend to think that there's no longer value in resources. Whereas in the emerging markets, all I have to do is look out their office windows and see all the construction activity going on around them. I've spent a lot of time in the developing world, in Asia in particular, and I've talked to a lot of these people. The question on their minds is, where in the hell are we ever going to find enough copper and iron and lead and zinc and nickel to keep this construction activity going at this pace? And therefore, it's the emerging market companies that see the value in the long term in the resources that are prepared to pay the prices. Look, these takeovers that I'm talking about have happened at premiums between 50 and 200% to what North American investors are prepared to pay for those companies at this moment.
That's a very interesting trend, isn't it? Just turning to the bigger mining companies, they've been hurt by rising costs of production combined with the lower metal prices. So do you see any way out of this predicament for the big companies?
Well, the big companies, and you look at Barrick, for example, for many years was focused on growing production, on growing reserves in the ground. They wanted to become a bigger gold company. And they made a lot of acquisitions that really didn't make a lot of sense. Part of their focus was on these big, low-grade deposits, which by their very nature are going to be high-cost producers. And they got hurt bad. They took a multi-billion-dollar write-off last year. Kinross took multi-billion dollars of write-offs over the last couple of years. Overall, the mining industry wrote off $50 billion last year, mostly related to acquisitions of projects that were big, low-grade, and high-cost. So they finally woke up and realized that they have to go to a new trend. The trend now is looking for lower-cost producers, which means higher grade. And by the very nature, just because of geologic reality, if you want a higher grade deposit, it's going to be smaller. So there's a big trend in the industry, and the juniors are starting to pick up on this, that the value, the takeover candidates are going to be the smaller but higher grade and therefore lower cost metal deposits.
And an investor should be looking at those high grade deposits.
And not necessarily super high grade, but it can still be a big open pit bulk mineable deposit. But instead of 0.7 grams, maybe the industry is going to need 1 gram.
Right. Okay. Just turning to gold. The gold price has been weak this year. Do you think this is a trend that will continue?
I always remind my subscribers and anyone else I talk to in this sort of a forum to not get hung up on the near-term moves in the gold price. It's just a reality of the current world in this internet age that we tend to think of a long-term trend as, the end of the trading day, or the 3-day settlement period as a long-term trend. If you look at the 12-year trend in the gold price, $250 in 2001, $1,600 more or less today. That's 6 times higher over 12 years. I don't think there's another asset class out there that's generated that kind of consistent year-by-year returns. Anybody who has bought into a dip in the gold market in the last 12 years has done well. And I see that trend continuing. I see this as a short-term dip, and it's going to continue the long-term upward movement that it's shown over the last 12 years. If anything, the fundamentals for the gold market are stronger now than they have been at any other time. Government debt in the U.S. growing faster than it has ever grown. The concern about the complete collapse of the euro has abated, but the problems haven't gone away. And Japan has now jumped on the bandwagon of printing money to stimulate the economy. So we see the dollar gain a little bit relative to the euro, and we think the dollar is strong. In reality, it just means that the dollar is declining slightly less rapidly than the euro. So that trend is still very much in effect. Currencies around the world are continuing to lose value. Gold is a hard asset that has a real tangible value. It will hold that value, and as more people realize that, demand for gold will continue to increase, and the price will at least hold its current level in real terms.
Right. Okay. You've said that your preferred gold investment strategy is to invest in gold companies rather than physical gold. Can you explain to our audience why you prefer that strategy?
Well, and it's not necessarily the best strategy for everybody. I live and breathe these companies, and I'm able to differentiate between the good companies and the bad. If an investor was to come into the junior gold market and buy gold companies at random, they would undoubtedly lose money. But if you pick a very carefully selected portfolio of the high quality companies, the returns can be spectacular. And that's what I'm looking at. I'm looking at companies that are giving you long-term exposure to the gold market, but at the same time, where you've got a smart management team that's adding value to a gold deposit. And in that way, the company is going to create shareholder value beyond the exposure to the gold investment.
Right. Okay. As you alluded to earlier, you spend a lot of time traveling, looking to identify good regions to invest in. Are you favoring one particular region or country at the moment?
You know, the more I travel around the world, the more I like it here in Canada and in parts of the United States.
Okay.
You know, the problems around the world are getting worse and worse and worse every day. We're seeing civil strife in various parts of Africa and in the Middle East, and we're seeing political problems of more subtle nature in various places. Latin America, there's a lot more opposition to mine development. And the other thing that's happening big time around the world are governments wanting a bigger piece of the resource pie. So governments boosting taxes and royalties and looking for carried interest in projects. So when you add it all up, what's happening in Canada, certain states in the United States, looks more attractive every day.
Great. Good news for people looking at Canadian and American companies at PDAC.
Absolutely.
Yeah, okay. Well, thank you, Lawrence. It's been great to get your insights here at PDAC. I've been speaking to Lawrence Roulston of Resource Opportunities Newsletter, and I'm Andrew Topf with Investing News Network. Thanks for joining me.